welcome to another edition of Morgan's Edward Street Wrap. The first one for me this year after a good little spell. I'm Matthew Gordon, and beside me is Brad Burns, and we are both private client advisors at the Morgan Edward Street branch. First of all, I'll briefly discuss the macro landscape, and Brad will finish off with his key stock selection for the week. Earlier this week, we had a well-respected fund manager, Hamish Douglas, from Magellan Financial Group, present to our network, and I thought I could share a few key takeaways from his presentation. Hamish discussed the volatility we have seen so far in global markets this year and the continued stance by the Fed to unwind quantitative easing by essentially selling US bonds, resulting in increased bond yields. With the US economy heating up and 3 to 4 rate rises predicted in the US this year, it's not a foregone conclusion that bonds could rise above 4%, and Hamish made reference to this. As such, there are essentially two key ways for investors to play this macro theme, in being reducing bond proxies and highly geared yield plays and increased commodity exposure. Hamish made mention that his funds have been out of bond proxies, which are mostly infrastructure and utility plays, for some time now. These highly geared businesses that have generous yields are disadvantaged by rising rates due to servicing debt levels on higher interest rates, and also the fact that rising bond yields as a rate of return start to look more attractive compared to bond proxy returns that carry company-specific risk. On the flip side, one of the best ways for your portfolio to hedge against rising inflation and bond yields is through buying commodities. Put simply, as goods become more expensive to purchase in the marketplace, so too become materials, and that are used to make them, and that's why buying commodities makes a whole lot of sense. So how will markets play out this year knowing bond yields are almost certain to keep rising? Again, Hamish mentioned to expect more volatility in markets this year as the Fed unwinds qualitative easing. So based on this information, I'd suggest speaking to your friendly advisor to see how your portfolio is positioned and which stocks best suit the topics discussed. I'll now pass over to Brad for his key selection for the week.
Thanks, Matt. This morning I'd like to bring ALS to your attention, stock code ALQ. In summary, ALS Limited is a global provider of testing and analytical laboratory services with headquarters based in Brisbane, Australia. The company operates 4 main testing service divisions, namely minerals, life sciences, energy and industrial across Africa, Asia, Australia, Europe and the Americas. Earlier this week, we caught up with the CEO of ALS, Raj Naran, who updated us on the business. In sum, it sounds like all divisions are tracking well across the board and problem areas such as life sciences are being addressed. The geochem business is still tracking well, currently in the midst of a slow season at present, albeit Raj noted the slow season started later than normal and signs it will end earlier than normal this year. Still seeing sample volume growth of 15 to 16% versus a strong period last year, and Raj is still optimistic in the upcycle but noted that capital raising activity, particularly among the smaller players, has not been as strong as he would have liked to see. Expects margins to tick back above the 30% level, underpinned by a switch from brownfield and greenfield activity and price increases being pushed through the division. The coal division has been strong, as has been for everybody, of course, and Raj is fairly optimistic on the outlook. ALS have been renewed their contract with BHP Billiton with a price increase. Metallurgy saw a lumpy first half, now seeing some projects dusted off, a lot of focus on energy metals such as cobalt, lithium and graphite. Raj also mentioned ALS have been doing some projects with both Tesla and LG. In the life sciences division, Asia Pacific is high margin, doing well in year-on-year growth and gaining market share. Latin America's, Raj believes they have turned the corner here, half-on-half growth and projected to continue for the next 2 to 3 years. USA, headwinds still remain, some activity in the infrastructure but no samples banked yet. Pricing generally stabilising. And Canada, which is another geography Raj said was in a turnaround corner. Double-digit growth for Canada. In Europe, food doing notably well, 15% growth. UK pricing still sluggish. Raj said the integration of Alcontrol UK took 6 months longer than it should have, but they have been rationalising costs and EBIT ticking up, but no revenue as yet. Raj still thinks Alcontrol is a 10 million EBIT business. Other general comments include ALQ doing some work in artificial intelligence to improve the speed of data analysis and reporting. And also looking at the introduction of drones to take samples from rivers rather than using boats. We have a $7.44 price target on ALS, and with recent market volatility, I think there'll be opportunities to buy the stock below $7 in the coming months. Matt?
Thanks, Brad. Good one. Well, that's it for another wrap. Please feel free to share this video with your colleagues and friends, and make sure you like the Morgans Ebbets Street Stockbroking Facebook page. Also, subscribe to our YouTube channel below. Have a great weekend, and we'll see you next week.